Hi everyone, welcome to Atr Markets. My name is Chris. Nenit, of course, is with us as well. And together we're going to take a look at price action strategy part 2. Last week, Thursday, we had part 1. You are able to find that first session, actually, if you go to YouTube, then look for Atr Markets and you'll find their channel and you'll be able to find this part 1 right there. So we're going to dive into this topic in a second. First, be aware that this webinar is shown to a global audience. Please take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out more if it is suitable for you and other details. Also, please be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. Plus, by continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, thank you so much for your attention. Last week, we're going to, of course, kind of continue based off what we did last week. I think that Nenad will dive into, a couple, I think one or two strategies in the second part of this webinar, like he did last week. I'm going to dive into basically using the psychology of the candles. I already explained last week how basically we can interpret candles, how we can interpret candlestick patterns by looking at not only basically wicks, but also at closes near the high and near the low, and the closes in relationship to the previous candles closes and highs and lows. All right. So what I want to do now is talk a bit about these various types of candles that we can kind of group together in these 5 topics. Typically, we would see on a chart, we would see either momentum candles. Those are the candles that are relatively large for their time frame. For a daily candle, that could be a 300 pip candle. But that could be for an hourly, a 50 pip candle, right? That's relative to the time frame. Momentum candles are relatively big candles. But we also have, obviously, reversal candles, where we see that price is showing exhaustion. It's maybe nicely moving up, good bullish candles, like this, as I'm drawing green, but we see suddenly here a candle like that with a big wick, a close near the low. Those types of candles are reversal candles, all right? Those are indicating that price will most likely not continue with the trend, but actually will cause some kind of reversal or retracement. So those are, in a way, opposites. In between those two, we have various types of different candles. Some candles do not give much information, like dojis. Those are indecision candles. Price is pausing, is consolidating, and it could indicate that price could go both ways. It doesn't provide us much information. Well, sometimes a doji does, of course, if a doji occurs in a way at a moment where we have a long uptrend and we see a doji, that could be a pause. It could mean that price might retrace after that. All right, but typically less information. Smaller candles also. There could be typically corrective. Corrections can last long. Less information there. And then we have pullback and continuation candles. It's not one candle, but let's say a series of candles, where we have, for instance, a couple of good candles. We see maybe a bit of a candle like this, and then we see a stall like this, but then we see all of a sudden the next good candle that pushes forward. All right. So in this particular context, this combination is in a way a pullback and continuation. All right? So these are the types of candles. We're going to talk about these candles specifically, actually, because we don't have hours and hours either. So specifically, we're going to talk about these 3. All right? What time frames print the most likely reversal candles? Martin is asking. And I mean, what I've seen from statistics is that the best ones are daily, the higher time frames, daily, weekly, monthly, sometimes 4 hours. But if you get into lower time frames like that, the candle itself is statistically not enough. In that case, we would want to have some confluence. We want to have some extra resistance. If there's a confluence of stuff like a fib, a trend line, a moving average, a pivot point, and then you see a candle like that, on an hourly chart, that is a meaningful candle. But if the candle appears in the middle of nowhere, let's say, where there's no strong resistance or support confluence, then an hourly reversal candle has absolutely less value than the daily. All right, so let's talk about momentum candles first of all, or as Dennett calls them, master candles, right? They're dominating the charts for a while, and we got a couple of examples. I hope you can see it well, indicated by those purple boxes there and those purple arrows, 5 of them. This is the euro dollar daily chart, and these 5 candles all are, good sized. All of them are at least more than 200 pips, which can also vary per pair, by the way. Pound yen, a lot of more volatility, so 200 pips might be very normal. It probably is for pound yen, but for euro dollar, 200 pips at least, right? For such a master candle. And we see 4 upside candles. We see 1 downside candles. What can we see from these candles? Well, we can obviously see that whatever the direction was of that momentum or master candle, whatever that direction was, we get follow through into that direction. We get a continuation of price moving in, further down if it's a bearish or up if it's bullish. Now, I'm not saying that these 5 examples are enough, but what I've seen from charts and charts and charts on high time frames like this, at least, and 4-hour and hourly as well, there's definitely a good chance of follow through if you have a strong momentum candle like this. Also, what we can basically read from it is that the opposite high or low will not be broken that quickly. Typically, you either have no retracement like here, or some retracement like here. I'm not even counting about this because I'm talking about the immediate follow through, but yeah, later on we do even get more. Here, hardly any retracement. Here, a bit of retracement, and here just hardly anything, just very little. So rarely, as you can see, does even the opposite high or low get challenged, let alone broken. So when you get candles like that, you can basically have, you get a good information about the direction levels that will most likely be respected, small pullbacks basically, and that will not be broken. That's valuable information. Now, I'm not saying that you would like to use those levels for stop losses. That could be probably on the high side for many of us. 200 pip stop loss is rather large for many traders. For long-term traders, it isn't. So that might be a consideration to take if you are a daily trader, right? For instance. So but it gives a lot of information, and it provided me information about my own trade here as well. As you can see, a trade taken earlier this week that ended up actually at break even because price started to revert back down. But you see that one of the things I looked at was this daily candle, and that was part of the reason why I was looking for upside. So how do you trade these momentum candles? What I like to do is then zoom in. If you are a daily chart trader, you see a big momentum candle on the weekly chart, you could zoom into the daily chart. Or you could just take that big daily candle at its close. Is possible. I would suggest to research that. It's not something I do myself. But I think that, considering what I've experienced with daily chart momentum candles, that makes sense. What I rather do, though, is because I can also have the time to analyze and follow the charts, perhaps. But if you are trading, if you have let's say a 9-to-5 job and you're trading in the evenings and mornings, all right, then you can still also do this. You can zoom in. You might have to put a pending order, but you can zoom in to lower time frames. Look at the 1-hour and 4-hour. And what I look for basically is a pullback and continuation and for the breakout. So that's why when I saw this triangle, and the triangle lasted already for a decent amount of time, and I was already in the live webinar this Tuesday saying that the euro dollar on the 4-hour, this is the 1-hour chart, but on the 4-hour chart needs to break, I think it was above the 4-hour candle highs here. It didn't do that on Tuesday, but it did on Wednesday, and I took the trade in the session on Wednesday, actually. Right? So Tuesday I was saying it needs to break above this level on a 4-hour chart. It didn't. It failed. It went sideways, but it did on Wednesday, so took the trade. That was the continuation perspective because we had a triangle here, as you can see, and we broke above the triangle. We had solid 4-hour candles above that triangle. Considering the daily candle, momentum candle, plus the breakout here was, from a price action point of view, I think enough to confirm a trend pullback continuation. And this was taken on the hourly. I think the setup looked the same on the 4-hour, to be honest. And up it went after a few hours at least. 1, 2, 3, 4, 5, 6 hours, and then it started to move up. So another trade setup from this week was on the Kiwi, the New Zealand dollar, right? We see trend. Look at this momentum candle right here. I think that this is the 4-hour world. This is a strong 4-hour candle. We don't even have to measure it. Just look at that candle size in relationship to the previous candles. Most of these candles, in fact, are bullish. The few bearish candles are small. The bullish candles basically typically have closes near the high, not in all cases. So you can see that this is a good momentum upwards. That's no doubt about it. And on top of that, we get a big momentum candle like that. All right. So what we then see is followed by a corrective bull flag chart pattern, a sideways move. Price action is showing mixed candles. And then on, I think it was Tuesday, in the webinar live, I took the trade on the Zealand dollar based on this particular candlestick formation engulfing twins. So here again, we're talking now about continuations. So we got a momentum candle. And on the same time frame, actually, I see the pullback and the continuation confirmation through engulfing twins in the right screen here, right here. All right. So the trade went fine, as you can see. The candles continued to push higher, and the price made a dash up, which was great, and it exceeded my target. I had a TP, a take profit, so I, didn't manage to maybe squeeze as much out of it as it seems here. I think I actually exited a bit lower here, so went a lot further than that. That's also the advantage of a trail sometimes, but that's a different story. All right, so that just a couple of examples here of this week. Let's talk about some more. So those are momentum candles in combination in a way with pullbacks. All right, but let's talk a bit more now about pullback continuation candles specifically, without any momentum candle necessarily nearby. So Monday Forex recap video, perhaps you looked at it or you look at it occasionally. On Mondays, I talk about the Forex market, euro dollar, pound dollar, dollar yen, Aussie, and I explain what I'm looking for. And in that video, I was looking at this situation right here. And you obviously can look with me and see the purple arrows, right? What do you see there? You see bullish momentum candles, strong candles, majority are bullish, sizable candles to the upside, small candles to the downside. And what do we see then? We see a bearish candle. And then we see a doji. So basically, some of you might think that this is a danger kind of area. And if we would not have the doji, all right, and we would only have that bearish candle, I would agree with you. I would say let's wait and see how the next candle appears. But if the next candle appears and it is a doji, and we've had a string of higher highs and higher lows, then this could easily be just a pullback. And my rule of 5 to 6 candles, basically not breaking a high, is very useful in this case for understanding if the continuation happens or not. If we look at the previous example, you can see in this piece that almost every candle pushes for a higher high. All right? If not immediately, then at least within 2-3 candles, like here. As soon as my rule is typically 5 candles. If 5 candles do not break a particular high, then a correction is most likely starting. 1, 2, 3, 4, 5. And indeed, we had a sizable kind of correction before we picked up speed again. So this was only 1-2 candles. So there's plenty of space and time, 3 to 4 candles, for this to continue. The bearish candle is indeed a potential reversal sign. or retracement sign. So what was my solution basically? This is a 4-hour candle, 4-hour chart. My solution was, and you can go back to the video, you can hear it live in case you want that confirmation, was to say, okay, I want a 4-hour candle that is a decent size. I think I was referring to 30 pips on a 4-hour chart, that is closing above this high of the doji and has a close that is near the high. So something like this. If we have a candle like that, it is an entry candle for me for continuation. So it's an example of pullback continuation setup. And why? I think I'm missing something here. Let's see. Apologies for that. There's something. Yeah, there's something clearly missing. Okay. Sorry for that. There should have been a follow-up with what happened. So no worries. Let me just pull up the live charts in that case. And we'll look at that instead. It's okay. Aussie. 4-hour. Let me use a blank chart. Let's see, where were we? Here. Oh yeah. Okay. So the position we were at was here. Here we go. Maybe just zoom out just a tad like this. Yes. Okay. So yes, that's the position here. Momentum, correction, momentum. So this is the candle right here. Okay. So I can zoom back in. So I got to context a bit. So let's look at this candle quickly. We have a decent sized candle. It was about 43 pips. I want to close near the high. What is near? Preferably within 20%. I mean, 25% is the best. So let's take a look. High and low difference is actually a bit more. It's a 58 pip candle to be precise. Okay, 58 pip candle. And the difference between the close and the high is 6.5 pips. So 6.5 divided by 58. Let me write that down for you. If we do quickly that math, 6.5 divided by 58. That's only actually about 11% wick if I did my math very correctly that quickly. So 11% wick, that's good. It's well within the 20. It's very close to 10, 20 within the 25, let's say. So that's great. So good setup, continuation, right? Nice rally up for 140 pips maximum profit pool potential. So yeah, that was a trade that went well. One of my trades that went well this week was on this Aussie based on that candle continuation. So that's a pullback continuation example. Reversals. So I think that a word of warning, a lot of reversals don't work well. Many times we see kind of, I would say, mirages. If you're walking in the desert and you see that well of water and you think, oh, finally, but it turns out to be fake. That kind of happens a lot with reversals, unfortunately. We see them all, I think, in general, maybe too often, too soon. And some, I guess it depends from trader to trader. Some just are more natural counter trend traders, are more contrarians than others. I am not much of a reversal trader or contrarian, so I don't have that problem that much. Others might have that a lot more. I think in general, though, if you see a lot of reversals, then you're going to have probably a tough time because there are not many reversals happening. A lot of times we get continuations. Look at this downside. It's just a follow through of continuations. Anytime you see a bullish candle, well, it kind of got smacked down again. So when the reversals do work out, I think higher time frames, a candle that is particularly big wick or particularly strong close. It just comes to mind right now that I actually was looking at the pound odd and euro odd. Pound odd and euro New Zealand. I was talking about reversals a week or two ago, and this really reversed a lot. Actually, I was talking about reversals, and this is something that I do with caution. I'm really careful with picking the reversals, but in this case, I was actually taking reversal trades on the pound odd because so many factors tied in, that made it seem very likely that a reversal was going to happen. And I took reversals in here and in here, way up there when it just started. I'm not going to dive into all the reasons why, but you can see that besides this small piece here, it was basically the second earliest you can get it. So what I was looking for was really just basically an ABC zigzag correction, but you can see sometimes corrections can start into, or reversals can start into basically new trends to the downside. And that's what happened on the pound odd. But this is a great example. Weakness, head and shoulders, a lot of things playing out here for reversals. Let's take a look though. The goal is price action. Let's take a look at candlesticks patterns to see what was going on there. And yeah, these were pretty good candlestick patterns there. Engulfing twins, strong candles near the close. 4-hour chart, by the way. We had momentum here too, with correction here as an addition. Daily chart, a decent daily reversal candle, I would say, considering the strong upside. So, those are things you want to look at for reversal candles. You got a strong momentum, and you got a strong, relatively, you want to find, this is not the best daily reversal candle necessarily, but you want to find a good wick, good close, and preferably also a high that is a bit higher here, so you had a bit of exhaustion, and a close that is below the previous close and high. Those are extra good pin bars. And this was one of a few examples where you can say that was a good reversal. So one of the things I look for is a 2-candle rule. Pin bars are good too, of course, but a 2-candle rule is good because often if you get 2 candles in a row that are decent sized, there's a higher chance that price will actually make a retracement or reversal. 1 candle, decent sized, and a decent close is often, is a bit on the weaker side. So if we look at, for instance, this purple box here on the left, we really didn't have good bullish candles, and we didn't get any really good move. Here we have 1 candle, but it got rejected too. But if you look at all the green boxes, except maybe, don't ignore this one and this one for the moment, and this one. But the other green boxes have 2 candles, and you do indicate either at least a decent retracement or a significant pause in the other trend. Here you get good continuations of the downtrend, and here you get some good pullbacks as well, or reversals. So 2 candles in the opposite direction of a decent size once again, is another kind of extra confirmation besides a pin bar. All right, so let's see. Anything else I want to check just quickly? Give me a second, folks. Yeah, I wanted to take a look at the pound odd. Sorry, with that 2-bar idea. All right, so let's take a look at the 4-hour chart again. Excuse me. All right, so here, if this was not a good pin bar, then the next one, look at that. And here 2 bars, and look at that follow through. Here 2 bars, again follow through. So even here, 2 up bars and still a follow through. It has been a rule that has provided me with quite, has provided me good decisions. Here, 2 bars follow through. This is not a reversal. This is kind of a trend reversal because we're up here. So this is kind of a continuation of the trend, but we also have momentum here. So, from that perspective, this could have been a reversal, a reversal on the lower time frame perhaps, right? But I think you catch the idea of what I mean with this. Here, 1 bar, didn't go anywhere. 2 bars, well, maybe this is not a strong candle, so I shouldn't count that. But here, 2 bars, and you get a bit of consolidation first, though, unfortunately, but then you get the follow through. All right. It's an extra rule. I wouldn't say a standalone thing. It's just extra element to consider. All right, folks. Are you ready for a quiz like last week? All right, quiz for you. Right here, the last bar, with everything we discussed so far, is this a reversal setup? Yes or no? So I'm talking about, I'm going to put a green circle around the bar, or I put a green arrow below it. And yeah, and I'll put a green arrow like from here, from the side. So you know which one. It's the very, the last one on the right. Is that a reversal setup? Yes or no? If yes, if you want to dive into details and you're in a mood to write, then how would you enter? And if no, why not? But why and then is for the moment enough. So we got, let's see what the score is. 1, 2, 3, 4, 5, 6. 6 for yes. And Martin is saying possible exhaustion wick. Yes, indeed. All right. So 7-0. Ergo is saying maybe bull flag, but says yes with caution. Okay. So let's talk about this setup. So we see, first of all, we do see 2 bullish candles in a row. So that's one of the things that I think is strong. We also see a close near the high with a very good wick. We see a close that is above basically the last close, the candle close. Not above the last candle high, but so we got a good kind of sequence here, I think, with the close and the high and the close above the previous close. Big wick. We had a good rundown. It's not in the middle of a range, for instance. That's something you want to be careful of. That's why I'm emphasizing that we had momentum down. Not because, obviously, momentum down is, in a way, showing that it's a bearish momentum. The goal of that, basically, is that we don't want to take pin bars in the middle of a range. That's the idea. If you got a range like that, and your price is moving up a lot like this, and you got a pin bar halfway here, that's not good. This is not a pin bar in the middle of a range. In fact, if we throw in a bit of support or resistance analysis, we could say it's close to support. Another factor that is good to take along with that. Considering that, and maybe even the total environment, we see a few bullish bars already before that, I think it qualifies to the things we've said. So yes, I think it's a good reversal. Indeed, I agree with the people who said yes. So let's take a look what happened, all right? We get a follow through. We got a candle to the upside. Sorry, folks. Okay, I confused. Apologies for that. Anyhow, we get a move to the upside. I thought I had a screenshot in between, but apparently not, maybe not. What about this candle now? I hope you didn't see the follow through there. I hope you didn't see the answers already in the future. Didn't think about that, but okay. This is the new candle, the next candle setup. So let's assume that we take the candle right here and we put the stop loss below the wick, and we're getting a follow through. We get a good bullish candle, we get a doji, again a bullish candle, and now we get a bearish candle, which is close to a doji, perhaps, but there is a bit of a bearish body. All right, so what now? What would you choose in this case? Would you go for a market exit? It's a bit more complex answer to give, but is it a trail, a market exit? What would you prefer in this case? A close and reverse, perhaps? A close, only a close, market exit? Would you hedge perhaps the profit? I don't know. I'm just throwing in some ideas here. All right, we got some good answers here. We have a couple of answers saying trail under the wick. We have a couple saying the trend will continue because of the long wick on the bottom, and others saying wait for better candle to short. wait for next candle, Aragon, based on the Agon, sorry, or Agon, perhaps, if it's a Dutch name. Then and the two candle, next candle idea, of course, based on the fact that we were waiting for two bearish candles as a confirmation. So I would say indeed that putting the trail, I think, from my perspective, is the best. I did this myself, by the way, this exercise. So this is what I was thinking when I was making these screenshots, that I would put the trail below these candle lows. And I don't think that this particular candle is strong to say that I need to exit necessarily on this particular candle. It's a small bearish candle. There's a wick at the bottom, actually. The close, indeed, is close above the close of the previous candle. And there's a significant wick. Okay, it was bearish, but it's very tiny. I think trail is best. I'm not looking to short here, just holding on, not looking to add at all, of course, but just holding on to that profit, locking in profit, and holding on if it can push further. All right, and I wouldn't even move to break even. I would move beyond break even because the rear entry is here, and I would lock in profit actually below that candle low right there. Locking in this, making it probably roughly like a 1-to-1 almost. 1-to-1 in the sense of reward to risk. All right, let's move on. Next question for you is this. This candle, again, what do you think here? It is a bit different because the candle body is a bit bigger than the previous one. I'll be honest with you, and we see that the candle high and the low are breaking the high and low of the previous candle. So that's a bit different situation here. Makes it a bit tougher. Now, if we could have been out of that trade, if we trail stopped this particular smaller candle, then we're already out because that wick took us out. Personally, I like to use strong candles for trail stopping. So I doubt I would use, this seems a bit smaller, this candle, plus there's a bit of wick at top. I would doubt I'd take that I would use this candle for a trail. I'd probably leave it there based on this candle. I would like to see strong candles like this, or very dangerous candles like this, or like this one, or strong candles like that. I would use all of these candles to move the trail, all 5 of them, but not this one, I think. But if we did, then we would be out, of course. So yeah, it's a bit of a toughie indeed. It's in a way it's engulfing twins, but the close is not near the low. So I don't think it's a strong reversal sign. I would not, let me be clear with this, I would not take a reversal. I would not take a short on this setup like this, but I would be scared for my long, and I would move it just a tad below this low. I don't think there's any reason to stay further than that. You know, what could happen is that price retests this bottom all the way back here. I don't think that makes sense to live through it. We do have a lot of momentum here, and we don't know how far this can push. It's really difficult to say how far that could go. So I think that locking in, being happy with a reversal trade like that, and just being happy with this profit makes sense. So that would be, I think, the ideal situation here. A market exit, I don't think makes much sense because anyhow, if we trail stop and blow this candle low, the difference is quite marginal, I think, from a daily perspective at least. Or one could opt for maybe taking some profit here and leaving part of the trade open. That could be another solution. All right, another potential trade management. All right, so what happened? Actually, let's skip a bit forward. We actually had indeed a bearish candle, and price did move. We didn't know exactly how far it went down. We said, but look at that. Sooner or later, we got a pin bar again. So, and that pin bar did cause again a new rally. So it was kind of a push-up, pullback continuation formation. So from that perspective, maybe there was more profit to be grabbed, but it is, based on what we see, difficult to know how far this pullback will go. So I think that still makes a lot of sense. And in theory, if we like this pin bar, we could still enter basically at the same price where we had the stop loss taken out. So that would not have been that bad either, necessarily, potentially there to enter that trade. All right, so What about this candle? I think this is the last one. Oh, I'm really running out of time. Time flew. Wow, it's going so fast. This is the last question, though. Is this an entry candle? Yes, no? Is this a, I don't say, you have to enter right now based on this candle close, but is this a candle that you would use, uh, considering the context that you see here, to take an entry? And you have to add the direction. And I was just about to say, preferably, I mean, I have Aegon saying yes down. I have some saying yes. Some others now saying Ron saying I go back to work if I see this. That's too big. Move too much for entry. Down. All right. So referring back to the start, the momentum candles. Momentum candles. I think it is a momentum candle. They don't break that often the highs, so I do think they're actually pretty safe to use as a trade. So I would say yes, it's a good short. Using the candle high for stop loss is very safe, but it's big. So it depends what type of trader you are. If you're using a momentum hourly candle, then the stop loss is maybe 50, 60 pips and probably doable for most of us. Or if you're using a daily candle, maybe not so much, because then you're looking, maybe this could be on the New Zealand dollar, this could be 150 pips, and maybe that's too big indeed for you. But if you are a daily trader, 150 pips is not big and could be worth it to take an entry right there. If you would take the example of the Kiwi to the upside earlier today, then what I would do is zoom into 4-hour and hourly, wait for some pattern there, and then break with that pattern with candlestick confirmation to look for continuation a bit later on. Using this as a trigger, but not as an entry. That's what I would do, basically. And what happened? Well, we had follow through here. We had a small candle. We don't know exactly what happened in that candle, but you can see some kind of consolidation the day after with that blue candle, and we got a bit of follow through before we get a bigger correction and again a follow through. So there was a bit of profit to be made. Then we do have two. Am I looking at the right spot? I am not looking at the right spot. Sorry about that. Am I? No, I'm not. This is the right spot. Yikes, apologies. They're so similar. This was the right spot, and you can see continuation, pullback, continuation. Anyhow, it did follow through to the downside. So that's my part, and I'm going to hand it over to Ned quickly. Let's see. Let me make him presenter first of all. There we go.
Thanks, Chris. Excellent presentation. So we will delve into two strategies today. So price action strategies part 2. I'm very good. Thank you for questions. And hi, guys. Hi to everyone. As long as you're concerned in our trades, well, New Zealand dollar setup that you can trade if POC is hit, it's still valid. So it might happen during the night or it might happen tomorrow. So it's still valid, okay? And there was a slight aggression. So we will simply delve straight to the point, and I will show you two special strategies. One is a bit simple, and the second one is it's simple. It's maybe a little bit more complicated, but actually it's also very simple. I think that you will enjoy it. So stay tuned. Okay. Fibonacci deeper retracement. Okay, this is actually for traders who cannot take trades, a lot of trades during the day. Simply for traders who are trading part-time and traders who don't want to mess up with a lot of analysis and with price action tools. Because of that, we use only two simple tools, Fibonacci and trend line. So here, very fast, guys. Time frame, 4-hour and daily. Chart type candlesticks. We use trend lines and golden ratio up to 88.6 retracement. So 61.8, 78.6, and 88.6 Fibonacci retracements. Stop loss goes 20 pips below above next fib level. TP's next fib, profit stops used heavily with this strategy. Okay, how it works on a live chart, I will show you just a second. So this is, as I say, very, very simple. So don't think that you cannot do this. This is actually what everyone can do it, and that is the magic of this. It's very, very simple, especially for traders who are very new to trading. And this is the screen. So here, guys, New Zealand dollar 4-hour time frame. You see now we're up. We already did the analysis for today, so it doesn't have to do anything with this. We need to go to the past. So here, guys, actually you need to have a clear trend on 4-hour time frames. Okay. Also, you need to connect at least 2 points like this. Okay, you see there are actually 2 points connected here, 2 points connected there. Why we connect 2 points? Because with a trend line basic definition, we say that the trend has been captured with 2 points, and 3 points make it even stronger. So we only need 2 points to capture the trend, the swing, okay, within the trend. That is a zigzag, okay? So here you see a trend line, a trend line. You simply wait for retracement. So let's say that you want to trade, you can always place multiple trend lines, guys, okay? But it needs to have perfect touches like this. Okay, so 1 touch, 2 touch, and trend line should be rayed, okay? What does it mean, rayed, okay? When you click trend line properties, you need to check ray. If you unray a trend line, it will not be long, okay? So trend lines should be rayed out like this. We also have here, we also can connect, we are able to connect actually 2 points, okay? Here with this trend line and with this trend line, these 2 points like this, okay? And what you do is simply you wait for retracement, okay, guys? You simply wait for retracement. Let me connect it. Okay, here, let's say this swing. It went up, then down, and you wait for retracement. There is a trend line. There is 61.8. As soon as the price hits 61.8, okay? As soon as the price hits 61.8, you sell. Actually, you wait for an X cross, guys. You wait for an X cross. What is an X cross? X cross is a simple trend line cross of a pivot point. Here, an X cross is a cross of a trend line and Fibonacci retracement. Okay, here you can also place a trend line. Okay, let me remove this all. Okay, how we will trade this. Okay, here, is there a trend line? Yes, there is. Okay, so connect it, guys. Connect all those important points. Okay, here you have a trend line connection. Here you also have a trend line, so do it as I do. Okay, here you wait for this swing. Insert Fibonacci retracement tool, okay? Let's say from this spot to this spot here, okay? Do you see something? Okay, here. Yeah, exactly at this spot we see a crisscross. Or if you are too late in a trade, you can use also most current swing like this. See, an X cross of 88.6. When you see the price is hitting this X cross here, okay? When you see the price hitting this X cross, you immediately enter the market, okay? So you don't simply wait for 4-hour candle close. Because if you waited for a 4-hour candle close, the price would go too far, you see? If you entered here, actually, that is, as you see, this is the level, okay? This is the level to enter. You can go 5 pips below, 5 pips, sometimes even 10 pips, so you can scale it, guys, okay? But the thing is, if you entered here, you would have made a really a much better entry than if you entered here at the candle close. It's 25 pip difference, okay? So, see, instead of taking 20 pips out of the market, you actually did it exactly where you should, okay? Here, another possible entry, okay, here, trend line, same historical trend line, an X cross of 50. But as I say, you can try to take 50, but I never do it, okay? This is 61.8, 78.8, 78.6, and 88.6. It goes in accordance with high momentum candlesticks, and this strategy, this is a long time price action strategy. I also use it in my practical naked trading. It will be introduced also in price action trading school, a little bit deeper. But at this point, just go with 61.8, 88.6, 78.6, and 88.6, okay? In the case of an uptrend, it's simple, guys. It's very, very simple. You also need to have a trend line touch, okay? You need to have trend lines connecting, okay? See here, for example, a lot of historical buying here. See here, there is really a lot of buying, a lot of interesting trend lines here, okay? And how you do it? Let's say that you actually are here. You want to wait, guys. This is 4-hour time frame trading. You need to put Fibonacci where it should be, okay? Here, do you see an X cross? Yes, an X cross of this level and an X cross of this level, okay? But here we have an entry, 78.6 X cross, okay? Here, price went here immediately when price hits this level, okay? It's in real time. You need to be very fast, okay? You're late in the entry, no problem. Wait for next entry. Next entry is here, exactly here, guys. Take it or leave it, 5 to 10 pips buffer zone. It's okay. This is 4-hour time frame. Okay, so 5 to 10 pips of the buffer zone from the next cross is a perfect entry. Stop loss is placed, okay, below next Fibonacci. Okay, so if this is 78.6, okay, we can use 20 pips because we are entering in an early trade. So if our entry was here, okay, 68.50, see 68.24, so 68.04 is only 44 pip stop on 4-hour time frame. Okay, so you see how it's easy. It's very easy to trade. You need trend line, and it's always best to have a historical trend line, as I'm showing here on this chart. What is a historical trend line? That line, it goes back into the history. Okay, if this is now, if for example this is now moment here, for example, this is history, guys. So always watch to the left. Price in Forex market tends to repeat, and that is the biggest advantage in Forex market, okay? So very simple strategy, go with it. If anything is not clear, feel free to send me an email. Of course, this will be covered also in price action trading school. Next one is Atr Breakout. Okay, now pay attention to this. Time frame 30 minute, indicators Atr 14, that is crisscross with EMA on the same window. I will show you how to do that. Also, this fractals indicator, if you don't have it, you simply need to email me. I will send you. When ATR is above 14 EMA, the market is active. When ATR is below 14 EMA, market is not very active, so don't trade. The rules, guys, please snapshot this. This is important now. This is the rules. So snapshot this screen. I will go with a live chart, but please snapshot this because this will be important for you to actually remember the rules. Okay, so this is, again, I'm giving you some time to actually snapshot the screen. Okay, so find the previous spot where ATR went below 14 EMA. Set breakout range with the arrow indicator. If there are several same color fractals found, use the most distant ones. When ATR approaches the 14 EMA from below and is about to cross, use market or pending order above and below the range. Wait for the trigger. Trigger is 3 pips above below the range. Stop loss slightly above the opposite range. Minimum TP target the width of the range. Keep a position as long as ATR is rising and it's above 14. You can use pivot points also. Okay? So the indicators are ATR 14, EMA 14 set on ATR 14 on the same window, and I fractals. How it looks is exactly like this, guys. So how you make ATR 14 having EMA 14 on the same window? Okay? I will show you now. Okay? First you go to Insert, Indicators, okay? And then you need to find average true range indicator. Okay, average true range 14 period. You place it here. Then you need to go a little bit different. This is how I do it. Go to indicators window here, okay, and just left click moving average. Then simply by holding left mouse button, place an indicator here. You see, I left clicked and then I'm still holding a left mouse button and I simply place the indicator here. It should be red 14. You can change the color, but this is where it's important. Apply to previous indicators data here. Click OK and you will have ATR. So let's see this example. So the first rule is find the previous spot where ATR went below 14 EMA. So let's say that you are here and this is previous spot when we have ATR, okay, went below, okay. So these are the spots, okay. All of these are the spots, okay. So if you want to take a breakout, take recent two swings. So recent two swings are obviously, okay, this is swing high, this is swing low here, okay. So this is the range, but the most recent swings are this one. As soon as price tends to cross this blue line, that is ATR, tends to cross 14, okay, see, it's crossing. You go out with a breakout, guys, but breakout happened to the downside, so you don't know where the price will be breaking out. See where the price broke out here, 3 pips below this low here, okay. You need to mark this high and low. So mark the low, mark the high, wait for a breakout, but you need to wait for this blue line to cross over the red line, because that means the market will become active, okay. And here this was a breakout, so the low of this candle was 1.4530, so 1.4527 is your entry here, and you see 25 pip profit potential. But for best risk to reward, measure the range. So range is 26. Well, that is basically it, okay. So you take the profits here, okay, simply when the price breakouts. Okay, let's see, for example, another example. Next one, where ATR went below 14 EMA here. So let's say this is the range, okay, this is the range, but you have swings. Most recent swing high was here, most recent swing low, okay, you need to go with indicators, guys, here, and you wait for this to happen. You need to wait for this. So your entry happened here, where? To the downside. You wait for the downside. You see, it went to the downside. Measure the range, 25 pip again, breakout below this candle, 3 pip below it, 3 pip below it, 44.96, 44.96, here is the entry, okay. So see, ATR breakout, price action, okay. Very easy, right? It's not that hard. One more example, dollar CAD, let's say breakout. This is the range, okay, where ATR went below EMA 14. Swing high, swing low. Here it started exactly at this point, it started to cross. So you take this breakout, guys, because it's below this range. So it started to cross and you go to the downside, okay. Next one here, see here, okay, the range, swing high here, and here it was a swing low, right? Price made it here, but it already started to break out, but usually this also will be enough to actually trade the price. Same here, guys, same here. Swing low, swing high here, and here the price actually started to, the ATR started to go above this EMA. Here, you see, you go to the upside. Interesting, right? So, any questions, welcome. If you don't have the indicator, email me. We'll send you, okay, here. Now, let's see pound yen. Ilya is asking how this strategy works on pound yen. Let's clear this. I don't know, let's use this example, okay, here. Swing low, swing high per this indicator. See here, your entry would have been initiated here, okay, so you see you would have, because the price already went below, you would have some drawdown, but then huge breakout. Huge breakout. I don't know now, the indicator, this is the indicator, this one. This is the indicator, Ilya. So if you want to, just email me, I will send it to you, okay? So this is the indicator. This is how it works, pretty much simple, okay? We can use another example. Of course, guys, don't overtrade. As in every strategy, do not overtrade. So here, obviously, well, this is the range. See most previous, but we don't have a swing high per indicator. So definitely, you can use it like this, but I want to see both swing high and low within this rectangle. So I want to see both highs and lows when ATR is below 14, okay? So let's use other example. Here we had a breakout. See here, swing high, swing low here, and price broke out here at this spot. See? Actually, it almost, so you just need, if you wait, sometimes if you wait for ATR to break directly, you will be late in the entry. But when you see that it's breaking, you just take the entry here. So this could have been your entry exactly at this spot here. Okay, so here it's trying to break out. Obviously it will go up, okay, and here there is a confirmation. See, it's simple, right? It's very simple. It can be very useful if you know how to correctly do it. One more example and we are ready to finish with the webinar. So here, do we have swing high, swing low? No. So guys, we need to have both swing high and low while the ATR is below EMA 14. Do we have here? Yes, obviously we have here both swing high and low. Or no? Still no. Okay, or this is, yeah, maybe we could use it like this. Okay, it can be that is touching, but you see there is no touch here. There is no touch here, so we need to be clear with the rules. Here we have it, okay, it's touching, it's sitting on it. It's sitting on it, and here, see, so this is swing high, this is swing low. Price started to break out at this spot, and actually you had also ATR going above 14, see? And your profit is 86 pips, and obviously it made a whole more profit. So yeah, pound yen is very, very good to try to trade this strategy. Do it on demo account first, and then if you are good, try to practice it if you think that it's good. But I think, yes, very often I take breakout trades with this one. So guys, that was everything today. This webinar is being recorded. It will be uploaded. Any questions are always welcome. We wish you a great week ahead. Stay tuned for next analysis tomorrow. And yes, breakout is trigger happy, Ilya. Exactly. As soon as the price breaks 3 pips below high or low, 3 pips, remember, 3 pips, no retest, trigger happy trade. These are the rules, so go for it and trade it, okay? No retest, trigger happy trades, okay? Very easy to use, very simple. You just need to practice it, and I'm sure that you will be fine, okay? One more question, Martin. Can you show me how to drag EMA to ATR window? Sure, once more, guys. Once more. How you do it, it's very easy. Okay. Insert, indicators, oscillators, average true range. 14, okay. Then click here, navigator window. Click on this window. Press left mouse button on moving average, hold left mouse button and place your arrow here. Okay, 14 exponential red. Apply to previous indicators data, like this. Is it clear, Martin? Okay, yes, you need to hold mouse button, indeed. You need to left click and hold mouse button. And then just move your mouse button on the indicator window. And you should be fine. Drag and drop, indeed, Ilya. Drag and drop. Exactly. Okay, guys. We will be here with you soon. As always, any comments, whatever, just send an email and we are glad to help you. Don't forget that you're trading with the best. Okay? Sure, no problems. Everything is fine. Use the strategy, enjoy the strategy, and send us comments. Cheers, everyone. Talk to you soon.